There is so much power in a policy loan. And so it should be in every decision you make. However, it's not free money. If you don't understand, it can hurt you. So don't just get excited about the value proposition of a policy loan and then go make bad decisions with it, because it is still a loan.
There's people out there, you'll find it on the internet, where people talk about taking a policy loan, running your daily expenses through that, running them through a credit card, paying them off with a policy loan, then running your income back into the policy. I think you're setting yourself up for some failure. What we teach people is how to store the capital, how to set up their infinite banking system. We don't tell people what they should invest in, because everybody's different. Invest in what you know, what you're comfortable with, and where you can reduce the risk yourself. So I think there's an important mindset there of how we do things. We invest to live, don't live to invest. Good morning, Sir Hans. Welcome back for another episode of Remnant Finance. It's
Good morning.
Today's the 10th, right? No, July 9th.
Yep. We got some big developments. We got the big beautiful bill is passed. So spending is going to go up. The deficit is going to increase. So asset price inflation seems like it should continue. So that's the biggest economic news lately.
I was gonna say the good news on it, like I'm not a fan of it for the deficit, for the spending, for all those sorts of things. The good news is the tax rates will not go up, which they would have. I still think money's better in our pockets, and it's kind of like the two things. Like if I can't control how much is being taken away from me, I'd rather have low taxes with a potential inflation, because I think that I can do things to mitigate inflation in my personal life in a microeconomic stance, through proper investments, through proper capital, through all kinds of various means. Like you can do things to overcome that, but you can't overcome a high tax rate. It's just going to happen. So, I mean, if I have the choice, even though I know this is just going to continue the inflationary environment, but that was going to continue under any administration and under any future bill that happens, as we've talked about, 100 times. Like I always love that one thing that Tom Woods always says is, like, no matter who you elect, you end up with John McCain. So, even though that's more on the war side of it, and the war spending and the neocon version, it's the same thing. Like no matter who you elect, they're going to continue the same fiscal policies. So if I can do those under at least a capped or the same tax rate I'm used to right now, and still have those same inflationary policies, I can do things to overcome that in a microeconomic environment. And I can't do anything about the taxes. So that's the one positive of that huge bill that I like.
Likely every single person listening, if you carve out finances and then you carve out taxes. The crazy thing is, this is not just a tax bill. This is not just a budget, a spending bill. Like, this is an enormous bill covering a preposterous range of things. And we know that zero of people in Congress actually read it, which is obvious given the length of it. And so we can, if we look at our tax situation, I would wager that every single person listening to this podcast, their tax situation is now more favorable than it was before this was signed, or at least with a lot of the TCJA cuts that were going to sunset at the end of this year being made permanent, you'll either stay the same or in some aspects get better. For instance, seniors 65 and older, if you turn 65 or older this year, for the next 4 years, there's an extra $6,000 senior deduction on top of the standard deduction, which is raised or is at least kept the same from what it was under the initial Trump cuts to TCJA. So there is certainly positive elements. And if we focus on this one thing, which of course, granted, that is our focus, is finance, economics, and taxation. So in that element, sure, that by that metric, I would say, yes, it's a win for all of us. At the same time, it is continuing to kick the can down the road. And there will never be an administration that ever cuts the budget. It just can't happen. And so we can always want to think about what can we control and what can we not control. Well, if we know this, we can't control that they're going to, all the money that they just cut from USAID, these good cuts, the tiny sliver of what they actually should have, but ended up cutting, I think, $9.4 billion. Well, that all just got moved and then some to the defense budget, which is now over $1 trillion. And that is a travesty. So the spending net is not going to decrease, but we can't control that. But what we can do is we can understand that our tax situations are now more favorable and optimize from there. So yes, there's certainly a lot of silver linings with it. Is it a betrayal of what the intent was and what the campaign promises were? Yes, of course it is, because spending is going to increase. But we can't control that, so we can just optimize within the framework that we currently have.
But anyway, we're not here to talk about that, right?
Yep. Yep.
We're here to talk about policy loans and some you've received just in the past week more than I did recently, but I get these over time. They're common of about when should I take a policy loan? So let's chat about like some reasons you might, some things you we don't think that it's necessarily prudent to take a policy loan for, some things you might take a policy loan for in regards to spending, some things you might take a policy loan for in regards to investing, when you would, when you wouldn't. Let's just open it up and have a chat.
Yeah. I'd say to start off, you'll find in the IBC community, there's kind of a philosophical spectrum of how people view this element of it. And this policy loan element is one of the major things. Of course, we want death benefit to protect our families. Like, of course, a bunch of things, come prior to this. But this is something that's very important because every time, every discussion we have when we look at an illustration, almost all of it is looking at cash value. It's looking at the return of cash value growth. When we talk about dividends, we're talking about cash value. We're talking about increasing our size of our policy. What is the point of having that cash value? Well, it's not just to be there, it is there and accessible. So the tool that we use to access it is the policy loan. We're not going to really go into too much of the mechanics here. We have an episode on the mechanics, but this is more the decision of assuming I understand how a policy loan works. Does it make sense here? And we'll hit on some mechanic things as they come up. But philosophically in the community, you'll find people, I would say, more along like Nelson Nash's stated goal of cutting out the snakes and dragons, as he said, which is not doing any business with banks. That's one of his key principles was don't do business with banks outside of the fact that a checking account is needed to facilitate and receive a policy loan. We're still using the institutions of banks, but we're not dependent on them. We're using them as a tool. We're not being used. And so on that end of the spectrum, philosophically, I am cutting out the fractional reserve system to the degree that I can, all the way to the other end of the spectrum, which is where you get in really the like that conversation I referenced recently, where it's this laddering IUL structure, and he said you can't do IBC with whole life because the arbitrage between the loans and the dividends and the internal rate of return, like so you're so scope locked on finding minute arbitrage value that you don't care at all about cutting out the banks. You don't care at all about the principles that Nelson was trying to espouse. You're just looking for a mechanical advantage in interest rates. It's all comes down to that, which everyone's going to fall somewhere on that spectrum. Brian, where do you fall on that spectrum?
I fall more on the getting out of the bank as I'm actually
Yeah.
working on doing that myself. But there's also somewhere in the middle that I think makes sense. Like whenever we're talking about utilizing it for investments, it all depends on the use of the loan, I think. And I'd like to speak actually to one thing that when Nelson talks about that, cutting out the snakes and dragons, there's something there that he says that I think people gloss over. If you make infinite banking a way of life, not just something you do on the side as the additional thing, but if you actually fully adopt this as like, hey, here's how I'm going to flow my money, he says it will take the average person 17 to 20 years to completely cut the banks out of their life. And there's a key word in the title of that book: becoming your own banker. You are becoming one. You're not all of a sudden one, and you're going to slowly through this process cut the banks out and take over the financing and the banking function of your family's life. But it's a long process, 17 to 20 years. And you are doing that as probably as the first person, the first generation to do that. So you're paying the cost, you're paying the time, you're doing this massive endeavor to set your family up to never need the banks. And so I always like to point that out because he talks about getting rid of the snakes and dragons. It is absolutely 100% not an overnight thing. We grew up in this banking industry. You spent your whole life coming up in it. It's going to take some time to get out of it. Just like for somebody that has become morbidly obese, they can't plan to become thin in 2 months. Like it probably took them 30 plus years to become that excessively obese. It's going to take them not 30 years, but it's going to take them probably a couple years to get to a healthy weight. It just doesn't happen overnight. We've been inundated with the banking system. So I think that's a key thing whenever we're talking about becoming your own banker, is that there's a time factor involved. You can't just simply slay them like overnight. I mean, maybe you can if you already have a massive net worth, but for most of us, you can't do it. But yeah, I fall somewhere in the middle. I believe that philosophically, exactly as Nelson taught, but there are times where I'll use a policy loan and like an arbitrage or for an investment thing where if I can make more money on that policy loan than it cost me in interest, it'll make sense and I'll do it.
Yeah, for sure. I'm I'm in the middle, leaning towards Nelson as well. There's a lot of situations where I think that the value of control that you get surpasses any kind of arbitrage and interest rate. If you're on that far end of the spectrum, which I think is just making a mockery of what the intent of this is, and just basically trying to impose an investing scheme onto life insurance. If you're on that end of the spectrum, then it's always going to be just purely down to the numbers.
You said
So,
scheme. IBC is a lifestyle. David
right.
Stern says that all the time right now. Nelson used to talk about that. You're talking about a scheme versus a lifestyle. So that's an important thing there. Are you trying to hack the system, or are you trying to develop a new lifestyle that betters your family?
Yeah, and the metric that you would, if you're on that far end of the spectrum, the only metric that matters is the highest magnitude of dollars. And I would much rather have 50% of, like, if I have an IRA and cash value that I can access, I'd rather have the cash value with half the balance of an IRA, because I still have 3 decades till I can do anything with that balance in the IRA. And so it's not just about the magnitude of the numbers. There's so much more to it. There's access, liquidity, control, guarantees, certainty, and then ultimately protection of the family. All the reasons that we love cash value as an asset in our portfolio. But at the same time, I can come up with a scenario where I would use lending from a dealership over a policy loan. If I can come up with a scenario where that's the case, and I can, then I'm not fully on the I will never ever use banks philosophically, even though I shade more towards that direction.
Like, what is it? What is one of those times? Share the example.
Yeah, sure. So let's say I have cash value, and now, of course, you could make up an interest rate where even the most philosophical purist who's saying I'll never touch a bank loan, you could probably come up with a scenario. We can play in the arbitrage interest rate world and probably come up with a scenario where they're going to break on that, right? I mean, it's never going to be this extreme, but if USA is offering car loans at 1% and your policy loan is somehow 20%, like, that's an easy call. Right. So I think there's a breaking point for everyone on that far end of that spectrum there. However, if I'm able to borrow from a dealership at, say, 3%, and it may be my policy loan, let's make it a little more realistic, a 6% car loan from the dealer versus a 5% policy loan. Well, if that's the only decision, is how do I optimize the purchase of this car, and I'm not looking at anything else, then of course the policy loan is better because the interest rate's lower. But even if the interest rate's higher, the policy loan in a lot of cases is still better due to the fact that payments go to principal only. I can pay when I want, if I want. I can make it an interest only loan. I can flip myself that principal for a while. Like, all the things we talk about, the mechanics of a policy loan, all of the things equal, I would always take the policy loan in that one specific instance, in this case of a car purchase. But if I'm also on the verge of investing in something with a much larger return, well, I would much rather pay the dealership their interest and earn a much larger return on my capital elsewhere. So that's a scenario. If I've got an investment opportunity where I've got reliability, I've priced in the risk, I understand, I trust, I've done all my due diligence, and I feel very confident I'm going to get, say, 20% return on this investment. Well, yeah, I'm going to take a car loan from the dealership all day if it means that capital can then go and get these much larger outsized returns. So you could twist the scales of the interest rate arbitrage and play in that world to make these decisions a lot harder for people that are, when all things are equal, firmly on one side or the other.
I think the car dealership one's interesting because you can look at that from an arbitrage environment, because it no longer exists. At one time, like, if you paid cash at a dealership, you could get a better deal. That just for when it comes to the car industry now, you can rarely get a better price with cash. You're
Right.
almost always just going to get the same price. Oh, okay, so you're just not financing this through us, but we can't give you any better deal than we already have. Those days are kind of behind us, but there's other markets where cash still is king. I've been looking up tractors as I bought that property. So I've been looking up buying like a compact or a subcompact tractor. And there are multiple $1,000s in deals if you're a cash buyer. So when I look at that, I can finance through them, maybe at a better interest rate. Maybe it's a 3% interest rate, and pay a few $1,000s more finance at that interest rate. Or I can come in with a policy loan, pay a few $1,000s less than that sticker price with a higher interest rate, knowing that it has all the benefits of a policy loan, pay it off, save money. So you really have to analyze every situation on a purchase. Now, if I can get a car at 1 or 2%, like we've talked about, the banker's in control, right? If I can swipe a check at any time and claim the title of that car, it might make sense to finance it through the bank. have that monthly payment, through the dealership or through USAA or whomever you got your loan through, knowing that I also have the full collateral over here in my policy loan. So I can, if anything goes wrong, if I lose income, I can just swipe a check from here, pay that car off, and not have to worry about it being repossessed. I'm still in full control of that situation. So you really just have to analyze those numbers. And like you said, do you have the investments in front of you? That changes the whole metric.
Yes, there's two things I want to hit on, and I don't want to get too far off on one. So I'll say the two things I want to hit on here is one, the fact that you finance everything you buy, and then also the ability to repay a loan can be a more advantageous position than having that loan paid off or having the asset paid off. The ability to pay down your mortgage if you need to, because you have a strong cash position, but you're using that cash elsewhere. And you know that if you need to, you can bring the cash back in, cut out the mortgage and be done with it, or pay down the car and be done with it. But if you understand that you could find a better use for that capital outside of this asset that currently has a note on it, well, the ability to pay it down and choosing not to can be a position of strength depending on your financial literacy. But the one I wanted to hit before that was the fact that you finance everything you buy. And if Dave Ramsey was capable of taking in new market information and new economic conditions and adjusting his advice that hasn't changed in 30 years, it should no longer, like you said, you do not walk in with cash and get a discount anymore. In fact, you often pay more if you pay cash than if you finance. Because there's a story that our friends Dave and Paul from the Wealth Warehouse podcast recently mentioned on one of their episodes. I think it was a client of Dave's, but he basically walked in ready to pay cash, also had a policy loan for the cash, and then could have financed as well. So all options are open to him. He's the banker. And he basically said, all right, well, if I pay cash, can I get a discount? And they said, no, but if you finance, you can get a discount. And he said, all right, well, what if I ask for a higher rate? And so he did his due diligence, made sure that there was no prepayment penalty, got the highest possible rate that he could, got like a, whatever, I don't know, $2,000 discount off of the price he would have paid in cash by financing at a higher rate, and said, dial up that interest rate as I'm guessing here, but like dial up that interest rate as high as you can to give me the lowest price on the car. And then 2 days later paid off the car in full. And so it's actually the opposite now, not in all cases, but in a lot of environmental and economic environments, paying cash can be a detriment. And if you look at, there's a website called fightingchance.com where he goes through the ins and outs of car buying. If you're going to go through the car buying process, you need to basically purchase his mini course. And then you can go to every single car you're looking for and find the actual itemized, priced out, like here's what the dealership actually paid. So you go in with this knowledge and here's the cost it took for them to ship it to you. He walks through the whole process. It's super helpful. But one of the things he breaks down, and he goes by company, by car company, what percentage of their dealership business is selling cars, what percent is service and maintenance, what percent is financing. And it's like 70+% of their actual profit. I'll have to check the reports here. I can pull them up right now. I'm not going to do that. You can do it yourself. But it's something absurd. Like 70% of the total profit of the dealership comes from the financing department. They are financing departments that sell vehicles to facilitate the financing. And so Dave Ramsey should stop giving that advice of buy a car with cash because you get a better deal. That's no longer the case.
It's absolutely not the case. And that just points right back to what is the most profitable business in the world?
Yep.
Banking.
Yep.
And, there was a time, I would imagine, I don't know how long ago, that the car dealerships made their money on margin. They bought it from the manufacturer, they sold it for an uptick, and then they made it on maintenance. But over time, like you said, their financing departments have become the largest leverage arm of the industry. And there's a simple truth to that, because banking is the most profitable business. And if you can become your own banker and take over the banking function, you earn the profits. That's the whole point of infinite banking, is that you can become the profiteer who has the control, who has the leverage, who earns the income through the banking process. So the car dealerships are doing it too. It's pretty wild.
We made the point without saying it that you finance everything you buy, in stating that if I have an opportunity to invest my cash value and I choose to take a car loan from the dealership because I can make more with my cash value. Well, what we're saying is that the opportunity cost of using that cash for the car and purchasing the car outright, the opportunity cost is what I could be making that's in addition. And so if we think about that, that underlines the fact that you finance everything you buy. If I withdraw 30 grand from my bank account and walk into the dealership, that 30 grand right now might be making you 3% in a high yield savings. It might be making you 10% in an investment, but whatever the case is, whatever it is making for you right now, you walk into the dealership and hand them that stack of cash, that cash can no longer work for you. It's actually going to work for them. And so on our blog, we have the article, you've called, you finance everything you buy, and we make the analogy of like a little black printer where you can dial in the interest rate, and whatever that interest rate is for you, that's your opportunity cost. Like if that interest rate equals the return you could be earning on that capital by doing something with it, you dial in that interest rate, whether maybe you don't know anything about money and that interest rate is 0.1% in a typical savings account at your bank. Well, in that case, you don't have an opportunity cost. You're probably better suited to use that cash to buy the car because you're probably not financially literate enough to do anything else with that money. And so in that case, don't go into debt. Don't finance with a dealership to buy the car if your printer on your that $30,000 cannot earn anything for you. Like, you should probably buy the car with cash. That's a good idea. That's smart. And that's, that is for the Dave Ramsey audience. Like, that is what a lot of them probably should be doing. But if you can dial that to even 4% in a high yield savings account or any kind of investment, whatever you dial that to, as soon as you hand that stack of cash over to the dealer, that little printer, now that printer prints for them. So we have to remember in all of this, we finance everything we buy.
Yeah. And it doesn't just print for them because they don't hold the money in some magic printing place. They deposit it in the bank. So it prints for them. And once again, it left your bank where it was making the bank money. It goes to their bank where it's making the bank money. So the banking industry, once again, always wins because the banker controls everything. That's where all the profit center flows. And that's what we're trying to stop. And that's why on the philosophical side of the argument, I lean more towards Nelson. We want to cut the banks out because they're the ones that are constantly profiting from everything we do instead of us.
Yeah. Let's talk a little bit more about the power of being able to pay something down that you mentioned earlier. That position of strength. Like, let's see if we can tie that into your example recently of purchasing that land. What if that cash value had been tied up elsewhere? You couldn't have purchased that land. And so like maybe you have a new mortgage on your house. If that 120 grand for the 5 acres? What if you had said, hey, I don't want to have a mortgage. I'm going to put that 120 grand towards principal in my mortgage, right? Well, now that land is probably getting dozed right now, and they're putting up, housing on it or something, right?
Foundation, right?
Yeah. Let's talk about that. The power of being able to repay it, but not.
Well, before I head into that, I also think that as you build this system, everybody needs to have a bottom end number. Like we talk about this should be your emergency and opportunity fund. So, the standard financial planner's recommendation is 3 to 6 months in emergency fund, whatever you're comfortable with there. So look at what you spend every month or what you make. That's up to you. Multiply by 6. And that's kind of like considered a standard emergency fund that you shouldn't go below. So we treat our cash value that way. So that's the first place. And then the next thing I look at and that I like to teach is that there should be some sort of reserve above that to take advantage of opportunities. So I've reached my 6-month emergency fund through the savings I've created and capital and within my whole life insurance policy. That there should be a next piece of that is kind of not just sent away for the best investment that I see today. What you find, Nelson talks about this in the book, is that opportunities find capital. So if you're somebody that can't have $10 in the bank because it could be doing something better, which is the person on that far end of that spectrum you were talking about, who is just like, but the arbitrage is bad. You could be making more money here. And they keep a minimal amount of reserves because everything has to be churning all the time. Well, if they just spent, half of their cash value on something that looked like a great opportunity at the time, and 10 days later, an opportunity that was double that comes along, they can't do anything about it because they left themselves no room for reserves. And so that's why, in my particular case, I was able to take advantage of that land right away. I told them I can close in a week if you want. They wanted a month, but because I've kept enough money, which was above that amount, in reserve in case an opportunity comes. Is this opportunity going to bring me cash? Not yet. Maybe someday if I figure out what to do with that land. But right now, it just allowed me to purchase that. So I had control of an opportunity when it came because I didn't jump around and look for every single possible way to make $1 out of that. I just said, hey, something could come. And when it does, I'm ready to spring. And nothing good enough came along in a while. I've got other money out in private investments. I've got other money out in different things, but like keeping a certain reserve, I think is important. And I kind of forgot your question, but I wanted to lead with that. What was the question you actually asked me?
Well, it was the power of being able to repay. So let's just make up an asset that you have. Let's say it's a tractor, and I don't
Mhm.
know tractor prices, but let's say you're getting a big old tractor and you just finance a tractor for $120,000. I'm going to pick the number equal to what the land cost. So you
Right.
have a $120,000 tractor that you're borrowing against, or you're borrowing from the dealer to buy this $120,000 tractor, and you're in a situation where you have a note. You're paying the lender to buy this tractor, and your current outstanding obligation is 120 grand. You also have 120 grand in cash value above and beyond your emergency fund. We talked through like these different avatars of how people think through this. Like your Dave Ramsey guys gonna say, how could you even have ever financed it? You should always pay cash. Your, you know, your solely arbitrage focused person might say, well, don't buy the land because you're not going to make any cash flow on it. You should invest that money elsewhere and do this, 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 and this. And then the philosophical one would say, you should have done a policy loan from the start. But now you're in a situation where you have the ability to do the policy loan. You decided to take out a loan from the tractor dealer, and now this land comes along. So like when we had this conversation, when we're looking at this decision of should I finance this tractor or pay cash or use a policy loan, which is nice to have all three options. When we're looking at that, the land's not in the picture. But you made a decision before you ever knew in this hypothetical tractor purchase. You didn't know about the 5 acres coming onto the market. Those are not revealed yet. And so you made a decision and you said, okay, I'm going to finance this tractor because I'd rather have my cash here for an
Yeah.
opportunity. And now look at that. Now you have the ability to purchase
Another
this land.
opportunity comes along
Yeah,
because you maintain some level of control. And an important part of that in that scenario is before the big opportunity comes for more land, is you always had the capability of paying off the tractor.
that's it.
So
That's the
you were
point.
still in control of that because you sat on an equivalent amount or more of cash value uh, compared to what you are financing.
Mhm.
So I financed $120,000 for a tractor, in this hypothetical example, and I had $120,000 in cash value. So I was always able to leverage that cash value and pay that thing off if the need arose. If that thing wasn't generating the income I needed it to, if payments got difficult on that, but I still had the $120,000 available for something else if everything's flowing well, which actually was my scenario, minus the tractor.
Yeah.
So now I can say I'm going to stretch out a little bit. I'm going to buy this land. I'm going to deplete that opportunity fund down to my emergency fund. I'm still in control of everything.
And what if let's say that you did, when you made this tractor purchase, you did know the land was coming online and you said, hey, I'd rather sit and wait for the land.
Yeah.
I'll finance the tractor. I have the power to pay it off if I want to. At any day, I could pay it off. But then let's say the land doesn't go through. They actually go with the commercial person or someone's even faster with more cash, whatever, and that falls through. Okay, well, now I can just choose to pay it off. So having three options, i.e., pay cash, finance, or use a policy loan, which effectively a policy loan is paying cash for the asset. It's kind of blending the two, but it's optimizing on paying cash, because if you want to pay cash and own the asset outright, you own the asset outright because you go to the dealership and you pay cash. To them, it's a cash transaction. But to you, you've incurred an obligation, but you've incurred an obligation to an entity you own versus to the dealership. So it's kind of the best of both worlds in my view, but I can see a situation where each might make sense depending on the person's situation and their understanding and their opportunity cost. And so having all three options is very powerful. And I think that I'm going to go with that land purchase. I think we made this point last time, but it's such a good, like, especially for you, like, emotional fulfillment for why we're doing what we're doing and why we're having this podcast and talking about finances, is at the end of the day, that land is not going to provide you cash flow. I mean, you've talked about ways you could. What if you grow a Christmas tree farm or whatever? But like, for all intents and purposes, there's no cash flow coming from that. That's purely an expense. But
Right.
what is cash flow for? Why are we investing in assets that acquire cash flow? In order to use them to do the things that make us happy and live the life we want to live. And you want to not have to look at construction or apartment complexes on the acreage behind you. You want to, like, that added so much value to your life, which is the intent of all of this. So we'll always come back to, it's not just about optimizing for cash flow, because optimizing for cash flow would say, now that you own this land, you should lease it out and build apartment complexes on it. And that would be the
And,
antithesis of what you want.
And I think there's an important mindset there is that what I believe in, and I think you're along the same way, and I think that most people should be, is that we should invest to live, not live to invest. If everything around your life is about churning money, imagine trading stocks in a way that you sit in front of your computer and what before and after the market closes, because now you're watching futures. Now you're watching all of your trades going up and down, and you're constantly have a ticker going across the screen. And if you step out for your kid's baseball game and that ticker changes and you're freaking out because you lost money, that is living to invest rather than investing to live. And I don't think it's a good way. So we should be doing these things and managing our personal economies in a way that improves our lifestyle and improves and lets us buy the things we want to do so we can live better, so we can live more freely, not so that we can consistently be concerned with every single extra penny and 1% of rate of return that we can get. That's a terrible mindset that kind of pulls you away from the important things in life, which we've talked a lot about. Your family, your free time, your faith. Like, where are you balanced in all this stuff if all you're doing is worrying about how you can churn every penny for the best arbitrage and squeeze a nickel out of three pennies? It just after a while, like you're actually living a lower lifestyle. So I think there's an important mindset there of how we do things. We invest to live, don't live to invest.
My situation here where I'm renting and not buying, I'm renting in a very expensive city, like, but at the end of the day, the life we have here, like how great it is, like is the ultimate endpoint. So if someone were to say you're not, you should be buying because you're paying, you're not getting any equity. It's like, yeah, but what do I want equity for? I've had this conversation before. Like, what do I want equity for in order to have capital? What do I want capital for is to one day live in a house like this on Coronado. It's like this is the endpoint.
I think it's a great example. I mean, people want to slice this down, like you're saying, down to the dollars all the time. Like, we're not, I've heard that 100 times. I've had discussions with family members about that, the renting versus the buying. Like, so just you feel like you're throwing your money away if you're renting. But sometimes it's better because you have a lot more freedom. I don't have to have maintenance expenses. I can, in your situation, you got a unique situation where you can live in a place that's like beautiful in an environment you want to be on the water. Everything about it's awesome. And so what if you're not getting some equity? You're living the life you want. I mean, you have a lot less stress. If something breaks in your house, like, it's not your
Yeah.
house. It's everything about it. Like, it's not a bad deal. Like, that again is just chasing the wrong metric. Like, are you going to go buy a crappier house just so you can have equity? And that, and,
Right.
and now have a lot more work to do. Now have a lot more money that you're throwing at the mortgage. It's like, it doesn't make sense. So sometimes that's a perfect example, actually, of trying to squeeze every single penny into a positive investment and always thinking about the financial side of it. Like, we should also be thinking about, how does this benefit my life and my family? And if it
Yeah.
costs you a little more money, and the opportunity cost of not gaining equity, but your family's living a lifestyle you want to, I think it's 100% worth it. I think it's a silly argument that people have without really analyzing the whole thing. And they're looking at it objectively rather than subjectively, typically. And it's like the far spectrum of IBC. They're on that arbitrage side. Like, oh my gosh, I'm losing money. Yeah, but you're over here. You're also probably more stressed. You're not living the way you want to live. You're focused on the wrong things all the time. So it's a great example, dude.
Yeah. Ramit Sethi is I think I don't really like most of what he puts out on the financial side, but he does make a point in this. I think there's a lot to the rent versus buying debate that I could be a whole episode because I feel pretty strongly that it is not, it's not even that I feel strongly. It's very clearly not always an advantage to buy. And the idea that your home is a primary asset is a marketing campaign. A lot of the things we think in the financial world are marketing campaigns, traceable, documented, provable. Home ownership is the American dream. Actually, like owning, like having a mortgage on your primary home, that's often a subpar decision. Now, it has been great for a lot of people that have ridden asset price inflation, but at the same time, that is not because the home itself is an appreciating asset. That's not what point of what we're talking about today. But a point that he makes is like people say, "Oh, you're paying your landlord's mortgage," and he says, "Well, when you go and get sushi, you're paying the sushi owner, the restaurant's owner's mortgage as well, but you're getting what you paid for. You wanted an experience, you wanted a certain thing, you were willing to pay for it, and that product was delivered. Why does it matter?" And when we think about like the when you analyze closing costs and you think how long you're going to have to live in that house just to, like, when you start with how much you have to pay and live in that house and pay a mortgage just to get to zero on the closing costs. I mean, you
Yeah.
could have been renting for like 3 years, but again, like my situation, I know how much people pay to vacation here for a month in the summer because one of my friends who grew up here, his mom still lives here, and we talk to her from time to time. She moves out for the summer and she rents her home out for 30 grand a month. I know how much people will spend to live here for even a month. And we live here year round and we live 3 blocks from the water. And it's like this tiny little beautiful ocean community on an island. Like people spend a lot of money to spend a small amount of time here and we get to live here. So that is, I mean, we're not going to be here permanently. We're going to be moving somewhere soon with land and, like we're not here long term, but while we're here, it's like vacation life, and this is the end goal for a lot of people, and most people can't afford to be here. And we have this phenomenal deal where I could never buy a property here, but I can rent it through this unique fortunate situation that I'm in. And so it would be a preposterously bad decision for me to try to buy a place here. But the situation that we have, anyone would be crazy to not rent in this situation. So it's not always black and white. It's about opportunity cost financially and opportunity cost as far as lifestyle and that life you want to live. I want to highlight a point that, again, shout out to our friends Dave and Paul, Wealth Warehouse podcast, their episode on 7 July. Dave made a really good, he broke down something that we're saying here with numbers in a really way that I think was helpful. And I'm going to change the numbers a bit because I think he had a whiteboard and was drawing through it. But here's an example of the power of the policy loan when we're talking about leverage. So if we have $1,000 sitting in a bank account and we have an opportunity to make an investment, and the investment's going to cost $1,000 and we're going to say that it yields 20% return, we could take that $1,000 and put it into the investment. And now after a year or whatever, we have our 20% return. We now have $1,200. What is our rate of return? 20%, right? We had 1,000. We now have 1,200. We made 200 on 1,000. But what it cost us to get that $200, we had to put up $1,000. Let's say we take a policy loan, and the policy loan is a 5% policy loan, which, most companies, that's around what it is right now. If I have $1,000 in cash value and I take a policy loan to do this investment, I tell the insurance company, basically, you're going to be fronting the money for this investment. I'm going to pay you interest on the policy loan. And so at 5% interest, I'm paying the company $50 and I made $200 still. So in that case, I put up $50 to make 200. Whereas had I put the money directly into the investment, I put up $1,000 to make $200. So my return went from 20% to 300%. That value of leverage there is incredibly powerful when you understand the value of using OPM, other people's money. Everyone in the real estate world knows that, which is why they tend to click with this idea pretty quickly. But the value of the leverage there is, you can't really understate that. And so it's not that I'm taking my $1,000, and this gets into the mechanics of the policy, but I'm not just taking my $1,000 from my policy, from my cash value, removing it and doing something with it. In that case, my return would be the same, the 20%, but I'm not doing that. I'm keeping that growing uninterrupted. So there is so much power in a policy loan. And so it should be in every decision you make, it should be on the table. And then you have to kind of rack and stack the options here, but it is a very powerful option that should be used. I would say it's hard to, more often than not, I would think it makes sense to use a policy loan. Of course, given a bunch of variables, that's not advice for your situation, but I just think that this tool, having it available to you, it's always going to be the first place I'm looking. And then the other options it's the burden is on them to be more viable than a policy loan in my mind.
Yeah. So do you have a metric of, if you're going to use, we kind of talked about using the loan early on in this discussion for purchasing something. What if you are going to use an investment? Do you kind of have a metric for that arbitrage side of it? Like, what would you be willing to take a policy loan at 5% and tie up? Because although, like you said, you're using other people's money, but it is treated like a home equity line of credit, whereas there's a lien against that portion that you've received as a policy loan, or that you've borrowed against in the form of a policy loan. So do you have kind of a personal metric for, like, what would your rate of return, let's call it, on that investment have to be to make sense?
Not as simple as if it doesn't yield X percent, I'm not going to do it, or X percent relative to the loan interest rate. I don't quite have that because, for instance, something like a rental property, when I buy those,
Mhm.
if I only look at the cash flow that I'm getting from the rental property, it wouldn't meet my criteria. But I'm also purchasing rental properties for the depreciation, as far as the taxation, the tax benefits, is also the likely appreciation of the property. And so there's a lot of reasons why I would buy a rental property. Cash flow is one of them, but I think it itself, most likely, at least the properties that I own, you know, I would make a larger return if I put that money that I use to purchase the property into an investment, whether it's forex or options or even just a market fund. I could probably make a higher return. So I don't have a set framework, just percentage to percentage. It kind of depends on what I'm trying to do. And I fall back to Joe Wither's asset allocation model, which has different categories. And so, you know, like market exposure is one of the categories, real estate's another one, precious metals, cash, digital assets, and early stage investments. And then within each of those categories, there's a minimum and a maximum range he recommends. I look at my chart if I have money to invest or I have capital and if I have cash value, and I kind of look at like, all right, right now I'm looking at it. I am pretty heavy in cash. I am right on the low end on precious metals. I'm right in the middle with real estate. I'm low on market exposure. So like market exposure is 10 to 20% per his asset allocation model, and I'm at 6%. And so I'll kind of gauge in there and get an idea of where I want to put, where I think I need to balance out the portfolio. But I'm also not, I don't just look at, I have some cash value, it has to go somewhere for the reasons we talked about earlier. Like, I don't know what opportunities are coming. So I'm not itching to get every cash value dollar working. But if I do see that I need some exposure, I'm going to rely more on the asset allocation model than I am on a set rate of return. Because like, I don't look at the stocks, Joe's stocks from the Phoenician League that I purchase. I
Yeah.
don't look at like what percent they're returning. I just buy the one that has the best value relative to the entry and exit prices. So I guess that's a long way to say no, not really.
For me, it depends on what we're doing. Like the real estate, I think you summarized pretty well. When I buy properties, I'm looking at the totality of what that property is going to do and the long range benefit of that. So the monthly cash flow might not give me the positive arbitrage against the interest cost of that loan compared to what I'm looking at, like you said, depreciation, asset, future increased cash flow, all those sorts of things. If I'm doing something along the lines of a more guaranteed, they all, nothing's guaranteed. They all have the risk, but like a hard money loan or something like that in the lending world where I've taken part in, I'm looking at straight up 10% minimum. If I'm not getting 10% return on that annually, I'm not taking a policy loan. Because my policy itself is going to do 4 to 6% annualized over the long term of that policy, net of, free of tax. So for me to trade 5% interest for a 10% gain on that, it doesn't make a lot of sense for me to lock up the capital for when a good opportunity comes. So somebody offered me, even if it's a pretty good deal where I would, historic me would have done it, and I can loan somebody $50,000 at 8%. I may have done that at one time pre IBC, but I just can't see the sense now that I'm flowing so much of my cash into the policies of getting an 8% return on a 5% interest rate. So I do look at the arbitrage in that regard, and it depends. Like, if I only loan to people that I have a history with and that I have never missed a payment and never not paid off a loan. So 10% is the minimum I'll go there. And I've had those offers like, hey, I've even had like one that was a mortgage offer to carry a 30-year note with them at like, I think it was like 6%. And I ended up turning it down. Where when you look at what the bank does, that can be a great deal because you're just about, if not more than doubling your capital input over the course of time. But I just didn't like the idea of tying up that large sum of money to mortgage that property, and only receiving a monthly little bit that starts to reduce the lien against my cash value
Mm-hmm.
over time. And so that money would be locked up for 15 years basically until I'm back to even, or, have paid that off. And in the next 15 years, there's going to be other better opportunities in my mind. So I turned that down. If it was a 10% loan, I probably would have done it.
Yeah, for sure. But imagine if, say, it was 12%, like too good to pass up, and you're sitting on your back porch watching those 5 acres get built on, like, because you weren't ready, because how happy would you be with that 12% return? So
Yeah.
none of this is like, and if you're looking for here's what I should do in this situation, here's when I should invest. Unfortunately, we don't, we're not going to be able to give you, you know, concrete answers, because even in our case, like everything we discuss can be kind of overshadowed by the fact that, well, I just love that 5 acre analogy. It's just so powerful as like the overarching value of what we're trying to do. And so there's not hard and fast answers here. It's having and developing a strategy when you get new information, being able to update and implement into your strategy to where you feel like you can make these decisions and you know what you're doing and why. But when should you use a policy loan versus finance with a dealership versus paying cash is going to be dependent on your financial literacy. The number, like the arbitrage is important. It's not nothing, right? It's not the only metric, but it is not unimportant. How much you want to just never philosophically do business with banks again. And then the other opportunity costs and the lifestyle things that could be happening that you don't even know about. So like think about what your 5 acres is. If that were to become available, would you be in a position where you could capture that? And you don't really know what you don't know, but it's helpful to kind of think holistically through these decisions to where it's not just, okay, I'm buying a car, the interest rate here is better than the interest rate here, therefore it makes sense to do this. There's like, think through it in the scope of your larger asset allocation, think through your daily burn rate, how much runway you have, think of your total liquidity, etc., because those are all going to factor into this decision, which gets back to there is no easy yes or no, you should use a policy loan in this situation kind of thing. But it's those are the conversations that I like to have and talk through. But we should be all making sure that our liquidity position, i.e., our cash value, is continuously growing in an optimal way so that we can take advantage of these things when they come along, and that so that when we walk into the dealership, we have the three options of cash, cash with a policy loan, or finance with a dealership.
Yeah. And what we teach people is how to store the capital, how to set up their infinite banking system. We don't tell people what they should invest in because everybody's different. Invest in what you know. We talked about that on a prior episode. Invest in what you know, what you're comfortable with, and where you can reduce the risk yourself. But if you want to think through some of these things, feel free to give us a call. We're not going to tell you what to do. We're not going to tell you how to do it, but we, having had this experience, we may be able, if you're a client of ours, that is, if you're not a client of ours, don't, well, you can reach out to us and maybe we can help you. But especially for our clients, I should say, first and foremost, I'm willing to take the time out of my schedule for 10-15 minute call to discuss your options, talk about, what you're doing, what the opportunity is, and maybe help you just see something you're not seeing that's out on the sidelines in your peripheral. We're happy to do that to help you make the best decision for you without actually telling you what to do, but help you think through all the other options and all the other things surrounding that policy loan. Oh,
Yep.
something you shouldn't use it for. I wanted to discuss that. I said that in the very beginning. I personally am not a fan, and there's people out there, you'll find it on the internet, and you'll find it in the forums and Facebook and TikTok and everywhere, where people talk about taking a policy loan, running your daily expenses through that, running them through a credit card, paying them off with a policy loan, then running your income back into the policy. And some people say doing this monthly, other people talk about doing it quarterly. I'm not a fan of that. I think that your expenses need to be your expenses that are handled from your income. Your policy should come from what you're capable of saving. I'm a fan of like striving for 25% of your income at least as you can, and graduate into more policies until 20 to 25% of your income is going straight into policies. But all of your expenses should come outside of that, at least early in your life. Like Nelson said, it takes 17 years to slay the snakes and dragons. So I don't think most of us are in a place where we should just be flowing our groceries through a policy loan. That doesn't make sense. Don't flow all of your expenses through. You can get caught up and not paying the loans back, having that interest continue to capitalize into the policy if things don't work out right. So I don't believe that this should be 100% of all of your income in the early stages going into and out of the policies. I think you're setting yourself up for some failure if anything changes in the income world. So yeah, I pay for our groceries, I pay for our utilities, I pay for our general day-to-day living expenses out of income, not out of a policy.
Yeah, it just seems unnecessary to me. I do all of our. I mean, I'd say 99.9% of our expenses take out rent, but like grocery, everything we buy goes on a credit card. We don't use debit cards for anything. I don't even know where they are. I know where one is in case the rare time we need to get cash, but I always use a credit card, and I'm like like spreadsheet daily tracker, maybe a little excessive. So I'm paying those things off weekly at a minimum. Like if I go a week without wiping everything off of the credit cards, like that's too long in my opinion. I've never in 15 years of doing this paid a single dime of interest to a credit card company, and I have a monster pool of points and rewards. So I play the travel credit card game. I don't pay them anything to do it. I mean the annual fees, like I was military, so I got those waived. If you're in the military and you're not taking advantage of this strategy, assuming you're not like reckless with your money, like if you can responsibly do this, this is a very valuable strategy. I haven't paid for a hotel or a flight in over a decade. However, I see the value of flowing everything through your credit card, but to me, there's no reason to introduce a policy loan to that. If I can pay off the policy loan with my income, I'll just pay off the credit cards with my income. That's what I'm doing. It seems like a pointless step to me. I don't see any value in doing that. And some people say you should only ever take policy loans to, if you can make more than than what you're paying on the policy loan. I don't think that's the case at all. Again, I think we made a pretty good case that there's definitely times when you could more optimally finance a vehicle, purchase land, purchase something that's not going to be directly, cash flowing to you. But that's not to say that every single expense should come through a policy line. It just doesn't even make sense. And I would steer clear of that. Unlike Dave Ramsey, I can give you blanket financial advice without any consideration for your personal understanding or family or financial situation. But in general, I think I could pretty confidently say that for everyone, that's probably a bad idea to just be continuously tearing through policy loans. There's just no reason. You're just adding a financing charge. I don't. It doesn't make sense to me.
Yeah, it doesn't make sense to me. Another thing, there's two sides to this coin that I want to address before we close out here. One is that you should not take a policy loan if you don't have a provision to repay it. Now, that doesn't mean that you don't have a provision down the road. And my example is actually perfect for that. So I tapped into my opportunity fund, and to the point where I'm like at the emergency fund level in what's available in my cash value because I had a lot of other loans out for other things. Why was I willing to do that and have no money available for opportunities or the next big purchase? Because my former primary residence is under contract, waiting to close. I'm going to refill. So basically, I've traded that house and a lot more, but I mean, a portion of the sale of that house bought this land. But I couldn't wait for the house to sell to buy the land. So I have a future provision. I'm not making a payment on it. I'm not making a monthly payment on it. When that house closes, I'll just pay off that policy loan in full. And that might be 5 years down the road. Nelson talks about that in expecting future windfalls. And he has a perfect example. If you find David Stearns on some podcasts, he'll actually talk about this. If you search David Stearns and want to hear the story, it's a great story. And I'll sum it up really short. He was building a house. He was rebuilding a house. And Nelson came to him and said, "Hey, do you have any policy loans?" And he was still thinking, even after 30 years and 20 some years of sitting next to Nelson in the office, old school, like, "Oh, I've got all this debt." And he said, "I've got about $400,000 in policy loans." And Nelson was like 86 years old at the time, and knowing that, his time was short. And he said, "Good, because you're going to have a windfall in the next couple of years," knowing that, his time's kind of coming up. And he wanted to make sure that David, his son-in-law, and his daughter had a place to plug that money that was going to flow to the next generation. So it doesn't even have, and that could have been a 5, 6, 7 year thing. But if there's a future windfall, it's okay. Like, take the policy loan. You have two options. You either take the policy loan with a provision to start repaying now, that'd be on something like a car, or you take the policy loan with knowing that there's a future, let's call it guaranteed, for lack of a better word, windfall coming your way, where you can refill that bucket. It's a great way to use the capital today, knowing that you can refill it later.
Yeah. One more instance of where you should not take a policy loan is to fund another policy.
No, yeah, laddering. That's
Yeah,
a technique called laddering. Don't do it.
you can find a lot about it on TikTok. That's kind of the most gimmicky side of this. Very dangerous, very high lapse rates, and going to get you in a lot of trouble. And in our little network, we've seen quite a good amount of fallout from that, of people being like, "Can you help me out of the situation?" And a lot of times you can't really. You overextended yourself. You don't have a plan to pay that back. That's something that if someone wanted to start a new policy and they told me they're gonna fund it with a policy loan, I don't think I would go through with that.
We're not a good match. Yeah,
No.
it's known as laddering, and I think it's a really poor technique.
Yeah.
It's trying to turn policies into a gimmick, a hack for I would call it, and it just doesn't work. Because if you don't have the money to fund the second policy out of pocket, what makes you think you're going to have the money to pay that premium ongoing for two policies and repay a policy loan?
Yeah.
It just doesn't make sense.
Yep. Policy loan is a powerful tool. It's an incredibly powerful tool, and it's built around the most powerful asset in your financial life. However, it's not free money. It's something you need to understand. It's a tool that can, if you don't understand it, can hurt you. So to don't just get excited about the value proposition of a policy loan and then go make bad decisions with it, because it is still a loan. You still need to understand it's way better than any other loan you can get, but you need to understand those mechanics and you have to plan to pay it back. Be a good banker. Plan to pay back your loans. But hopefully this discussion helps if you're one of the quite a few who have reached out to me recently to have this discussion. Hopefully this helps maybe move you in one direction or another. Like Brian said, if you're one of our clients, we're happy to talk through this decision with you and point out some things and see how we might think through it. But at the end of the day, being in the position where you have the capital available and ready to go to take advantage of optimizing a large purchase, making an investment that's going to cash flow, making an investment in lifestyle that's not going to cash flow. There's a lot to think about here, and there's a lot to think through, but hopefully this discussion helps.
Yep. And if you get any value from this, we'd appreciate it if you would share the podcast. Please like, subscribe, all the things. Helps us out a lot. And we want to keep getting this message out there to help more people stop being a passenger and take control of their finances and their capital.
There we go. Cheers, y'all.
All right. See you.